Growth investing is probably one of the most commonly thrown around words in the middle-class investing sphere. But at the same time, the word is used in so many different contexts that no one actually knows what makes it different from other kinds of investing. And even more importantly, the more you look into it, the more you start to hear about something called value investing, and that does not help with the confusion either. This is why today, once and for all, we're going to tell you not only what makes growth investing so special, but why, for almost all intents and purposes, it is better than value investing. And if you are someone who's into that sort of thing, make sure that you watch the video till the end, because I'll be keeping the most important bits for last. So, without wasting any more time, let's jump in. What makes the two different? Now, while every investor has their own way of choosing stocks and functioning in the stock market in general, for most people there are two modern ways of investing. और अगर आपने investing types पर एक भी वीडियो देखी है, तो आपने यकीनन इन दोनों का नाम तो सुना होगा. You guessed it, these are growth and value investing respectively. And choosing between the two is sometimes shown to be as difficult as choosing between capitalism and communism. And while बात इतनी भी मुश्किल नहीं है, the principal style you choose in your investing career can still have massive implications on how much you earn, how much you work, and how long it takes for you to achieve your goal. But what exactly makes them so different? Well, to put it plainly, the difference between growth and value investing is the same as the difference between buying an expensive but long-lasting jacket or buying a ton of cheap and low-quality jackets. Or in financial terms, the goal of growth investing is to find stocks that have the promise to outlast their competition and steadily grow in value, while the goal of value investing is to find a stock, whether good or bad, at a price lower than its actual worth. The idea being that if you buy enough stocks for little to no money, even if you make money off of just a handful of those, that profit will be far greater than the price. By comparison, in the former case, the main driver of the profit will be the actual performance of the company, and by extension the stock that you are investing in. And while there are a ton more things that differentiate the two on more technical levels, what we have told you up till now should be enough to allow us to explain how the rest of the differences make growth investing the wiser option for investors such as yourself. But before we get into that, if you're liking the video until now, please leave a like and subscribe to the channel so that we can continue to provide quality financial content to viewers like you. Now back to the main content. Let's talk about the first reason why you should consider growth investing over other kinds. Reasons growth investing is better. Number 1. Growth investing is more versatile. By far the biggest reason why people like you and me should prefer growth over value when it comes to investing is that to fully maximize profits in value investing, you not only need to have a ton of capital at your disposal, but you also need a lot more time to select stocks. Not to mention the time and money that will be wasted making mistakes, because let's face it, knowing the actual intrinsic price of a company is not something anyone can do without a ton of practice. By comparison, while selecting growth stocks is also not a super simple task, it can be done once and then let go as the stock grows. In fact, growth investing is famous for having similar returns for seasoned investors, funds with a ton of experienced employees, and small part-time investors like you and me alike. There's also the matter of, number 2, growth shows results in short or long term. The main focus of growth investing is to find stocks that will grow immensely in the coming years, which means that if you do everything correctly, you'll see results in a short time. But even over extended periods of time, growth investing has been shown to outperform all other kinds of investing by a long shot. In fact, for anyone looking to generate wealth, value investing is simply not an option. So, if you're someone who wants to save up money instead of taking out payments every now and then, you better look into growth-based stocks. And there are even more specific benefits like being, number 3, growth stocks are safer in tough times. It might not be obvious at first, but one of the biggest reasons growth investors outlast their value investing counterparts is that growth stocks are inherently safer in times of inflation and market downturns. This is because instead of being on the market, these stocks focus on the company itself, and unless the company itself starts to falter, no matter what happens in the world, your growth stock will continue to grow. In fact, these differences in approach and results are not the only reason that bracketing growth investing makes more sense. The major growth and value stocks in the market right now alone should be enough to convince you of just how effective growth investing can be. Number 4. Growth stocks have been historically stronger. A great example of what makes growth stocks superior to value stocks is the simple fact that the top 5 list of growth stocks would include names like Apple, Amazon, Coca-Cola, and others like them. By comparison, not only will the names of the best value stocks be far less recognizable because, again, they are not always the companies with the best performance, but simply the company with a lower price than their performance. Even if you did ignore all the small companies, most value investors will still end up investing in the same stocks as growth investors. That's because, for most serious long-term investors, value investing ends up as less of a trying to get the cheapest stocks at the lowest prices, and more of an I have to get the best stock at the lowest price struggle. You can even see it in the strategy of some of the world's biggest investors in our next point. Number 5. Growth-based investing is preferred by seasoned investors. Take Warren Buffett for example. Since the start of his career, he was probably the most famous value investor in the world. But over the years, he has gone from trying to find super cheap companies like other value investors to looking for companies with the most potential, only at a fair price. As he himself once stated in a talk with business students, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Even other names like Thomas R. Price, Peter Lynch, and Carl Icahn all prefer the philosophy of looking for valuable, good businesses over prioritizing price. And you can even see the results of this investment in actual studies. Number 6. Growth investing is backed by studies. A lot of big value investors will say that value has at many times in the history of the stock market outperformed growth investing. The fact of the matter is, even with many 4, 5, or even 7-year periods of value investing being supreme over the course of the last few decades, studies have shown that growth investing has never once stopped being the bigger performer. Hell, even going as far back as 1926, people and organizations that prefer growth model are still going strong, while value investing has always had its periods of popularity followed by subsequent decline. So, now that we know why growth investing is better at a practical and theoretical level, and have seen how the biggest investors and studies all favor it, I think it's time to bring it all home. The bottom line. Now, to summarize, growth investing is safer, easier to learn, is scientifically shown to show more consistent results, and can be done by even an unseasoned investor like you or me. But even that doesn't cover the entire story. That's because even though I've just spent the greater part of the past 8 minutes advocating for growth investing, the real benefit of being a growth investor is the fact that it is not based around one set of rules. Unlike value investing, which looks at a ton of facts and figures and only then selects a few simple stocks, your method of growth investing can be entirely your own. This is why a ton of major investors, even those who by principle are value investors, end up behaving as growth investors. Because over time, all investors end up looking for good long-term stocks instead of smaller ones with a shot of value. So, why waste your time in the first place? And yes, if you are someone who prefers to remain hands-on and likes to take out profits throughout their investment tenure, you'll probably prefer to add some value investing principles to your portfolio. But take away some of your time, and even you will start to invest in stocks that can carry themselves. In fact, apart from only the most involved investors, which is basically everyone, starting with a growth-oriented mindset and then working their way out from there is the only way to go. And as long as you continue to apply the same mindset throughout your investment journey, I'm sure that you'll find an investment method that matches your personality and gives you the maximum profit. And that should be enough to tell you everything you need to know about what makes growth investing so special. And with that, we must pass the question on to you guys. Which style do you guys lean towards? Value investing or growth investing? Please let us know in the comments below. And while you're at it, if you like what you learned today, you might also want to check out our video on Morgan Housel's legendary book, The Psychology of Money, which will tell you some of the most well-hidden and simple secrets to success in the financial world. And well, on that note, we must end today's video. I hope you enjoyed watching it, and if you did, be sure to leave a like and subscribe for more. With that, take care, and I'll see you guys next time.